If you had $100,000 to invest today, there's a simple question that sounds easy, but actually isn't. Which one grows your money more? Fidelity or Schwab? Because on the surface, they look almost identical. Both are massive institutions. Both offer low-cost index funds. Both are trusted by millions of investors. But when you zoom in just a little bit, small differences start to appear. And over time, those small differences don't stay small. They compound. In this video, we're going to put $100,000 head-to-head into Fidelity versus Schwab index funds. Real numbers, real returns, real compounding over decades. We'll compare fees, S&P 500 performance, total market funds, bond funds, and international exposure. And at the end, you'll see which one actually leaves you with more money. Not by a little, but by a margin that could reach over $1.5 million in the long run. But before we jump into comparisons, we need to make one thing clear. Because if you don't understand this, nothing else in this video will make sense. What exactly is an index fund? An index fund is simply a basket of investments. Instead of trying to pick individual stocks, guessing which companies will win, timing the market, you buy the entire market at once. Hundreds, sometimes thousands of companies, all in a single investment. Most index funds track something like the S&P 500, which represents the largest companies in the United States. The goal is not to beat the market. The goal is to match it. And because of that, the costs stay extremely low. No constant trading, no expensive managers, just steady exposure and long-term growth. And that's where things get interesting, because when costs are low and strategies are similar, the real question becomes, which one is slightly better? Because in long-term investing, slightly better can mean hundreds of thousands or even millions of dollars over time. Let's quickly look at the two players. Fidelity, founded in 1946, managing over $18 trillion in assets. And in 2018, they did something no one else had done before. They launched zero expense ratio index funds. Zero, as in no annual fee at all. Then there's Schwab, founded in 1971, managing nearly $12 trillion in assets. Known for pioneering low-cost investing, their funds are consistently among the cheapest in the industry. So on paper, both look like safe choices. Both look efficient. Both look nearly identical. But here's the truth. When you're investing $100,000, you're not choosing a brand. You're choosing a structure, and that structure determines how your money compounds over decades. So we start with the first and most important factor for any long-term investor, fees. Because before your money grows, before returns matter, before compounding even begins, there is one thing that always comes first: cost. Let's start with something that most investors underestimate. Not because it's complicated, but because it looks too small to matter: fees. Here's the good news. Both Fidelity and Schwab are among the lowest cost platforms in the entire industry. No commissions on U.S. stocks. No fees for most ETFs. No account minimums for standard brokerage or retirement accounts. At a glance, they look identical. But investing is not about what's obvious. It's about what's hidden in the details. And that's where the difference starts to appear. Every index fund charges something called an expense ratio. This is the annual fee taken directly from your investment. You never see it. It's not billed. It's just quietly deducted from your returns every single year. For most funds from both Fidelity and Schwab, that number sits around 0.02%, which sounds like nothing. And on a small investment, it almost is. But over decades, even tiny percentages compound into real money. Now, here's where things change. Fidelity offers something no one else does at scale: zero expense ratio funds, funds like Zrox, FZilks, FNILks, FZipX. These funds literally charge 0%. No annual fee, nothing taken out. Schwab does not have a direct equivalent. They are extremely cheap, but not zero. And that difference creates something very important, a structural advantage. Because when your cost is lower, your compounding starts from a higher base every year, without exception. Now, you might be thinking, it's just 0.02%. Does it really matter? Over 1 year? No. Over 5 years? Still small, but over 20, 30, 40 years, it becomes very real. Imagine two portfolios. One grows at 10%. The other grows at 9.98%. That difference seems invisible. But after decades, it turns into thousands, then tens of thousands, and eventually much more. This is why serious long-term investors obsess over fees. Because fees are the only thing in investing that are guaranteed. Returns are not. Markets fluctuate, but fees are always there. Every year, no matter what. Outside of expense ratios, both platforms are nearly identical. Options trading, same cost. Account fees, none. Basic investing structure, almost the same. So when John looks at the full picture, he sees something subtle but important. Fidelity gives him a way to invest with literally zero cost on certain funds. And that's not marketing, that's math. So the first round goes to Fidelity, not because Schwab is expensive, but because Fidelity found a way to be even cheaper. But here's the key insight. Fees are just the starting point. They tell you how much you lose, but they don't tell you how much you gain. Because at the end of the day, what matters most is not cost. It's what your money actually does. And the best place to test that is the most important index in the world, the one almost every investor owns, the one that defines the market itself, the S&P 500. Now we move to the most important benchmark in investing, the one almost everyone talks about, the one that defines the market, the S&P 500. If you've ever heard someone say, the market is up today, or the market is down this year, they are almost always referring to this index, because the S&P 500 tracks 500 of the largest companies in the United States. Companies like Apple, Microsoft, Amazon, Google. It represents the core of the U.S. economy. And over the past decade, it has delivered something remarkable. More than 14% average annual returns. That's one of the strongest long-term performances in modern investing. Both Fidelity and Schwab have built flagship funds around this index. Fidelity offers FXAIX. Schwab offers SWPPX. On paper, they look nearly identical. Same companies, same weights, same structure. So John decides to test them, not based on theory, but based on real numbers. He takes $100,000, invests it into Fidelity's FXAIX, reinvests every dividend, and lets it run. After 1 year, 11,490美元. After 10 years, 36,214美元. After 20 years, 125,9752美元. After 30 years, 431,092美元. Now, he runs the exact same scenario with Schwab's SWPPX. Same $100, same reinvestment, same time horizon. After 1 year, 11,410美元. After 10 years, 36,370美元. After 20 years, 127,9591美元. After 30 years, 442,7256美元. At first glance, the difference seems small, but after 30 years, Schwab finishes ahead by over $116,000. Now here's the important question. How can two funds tracking the exact same 500 companies produce different results? The answer comes down to something most investors ignore: dividend growth. Schwab's fund has historically grown its dividends faster, around 7% annually, compared to Fidelity's roughly 4%. That difference doesn't look dramatic year to year, but over 3 decades, it compounds into real money. This is the first big lesson. Even when investments look identical, the details matter. Two funds, same index, same companies, but slightly different structures, and over time, those differences show up in your account. So John gives this round to Schwab. Score so far, Fidelity, Schwab 1. But here's where things start to shift, because the S&P 500 only covers the largest companies. It leaves out thousands of smaller ones. And those smaller companies often carry higher growth potential. So the next question becomes, what happens when you invest in the entire U.S. market? Not just the top 500, but everything large, mid, and small companies combined, because this is where the gap starts to widen. Now we move beyond the biggest companies, because the S&P 500 only shows you part of the market, the top layer, the skyline, but it leaves out something important: everything underneath. That's where total market index funds come in. Instead of tracking just 500 companies, they track thousands. Large companies, mid-sized companies, small companies, all combined into one portfolio. Think of it this way. If the S&P 500 is the skyline, the total market is the entire city. And historically, smaller companies tend to grow faster. They're less established, more volatile, but they offer higher upside. So John wants to see what happens when he expands his investment. He takes the same $100,000, same rules, same dividend reinvestment, but this time he invests in the full U.S. market. Fidelity's fund, FZROX, Schwab's fund, SWLSX, both cover roughly 2,500 to 3,000 companies. Very similar strategies, very similar exposure. But again, similar doesn't mean identical. John starts with Fidelity. After 1 year, Shri Wan Sichen Sabai Chisha Yuan. After 10 years, Sanshi Chi Wan Chi Chen Jobai Josha Yuan. After 20 years, Ibai Sanshi Bawan Nanchin Sabai Arshaba Yuan. After 30 years, Sabai Josher Lo Wan Ba Chen Jobai Josher R Yuan. Now he runs Schwab's version. Same setup. After 1 year, Shri Wan Senchen Lo Bai Chisha Yuan. After 10 years, Sanshi Wan Ling Ubai Arsha Jo Yuan. After 20 years, Ibai Isha Ba Wan Lao Chen Baba Lo Shi Yuan. After 30 years, Sambai Josher R Wan Lao Chen Ubai Isha Ba Yuan. This time, the difference is not small. Fidelity finishes ahead by over $1,046,000. So what caused such a massive gap? Not fees, not structure, but something else. Growth rate. Fidelity's fund delivered around 13.43% annually. Schwab's delivered about 12.57%. That difference, less than 1%. But this is where compounding becomes powerful, because compounding doesn't grow linearly. It accelerates. A small gap in yearly returns becomes a massive gap over decades. This is the second big lesson. You don't need a huge advantage. You just need a consistent one. So John gives this round to Fidelity. Score now, $2. At this point, Schwab is slightly behind, but there are still 2 categories left. And the next one is something many investors ignore, even though it plays a critical role. Bonds. Most people focus only on stocks, growth, returns, upside. But bonds serve a different purpose. They provide stability, income, balance when markets become volatile. And here's what makes them interesting. Bond funds don't rely as much on price growth. Their real power comes from income. Dividends paid consistently, reinvested and compounded over time. So now the question becomes, which provider builds a stronger foundation, Fidelity or Schwab? Now we move into the part most investors overlook, but shouldn't: bonds. Because while stocks get all the attention, bonds are what keep your portfolio stable when things go wrong. They reduce volatility. They provide income. And over long periods of time, they quietly compound in the background. But bonds work differently than stocks. Stock returns are driven mostly by price growth. Bond returns are driven largely by income, regular interest payments, reinvested, compounded over decades. So John runs the same test again. Same timeline, same reinvestment. Fidelity's bond fund, FXNAX, Schwab's bond fund, SWAG-X. Both track the same index. The Bloomberg U.S. Aggregate Bond Index, same benchmark, same category. So again, this should be close. John starts with Fidelity. After 1 year, Shri went down Chen Lo by Sanshirmayan. After 10 years, Sanshir Arwen Ba Chen Ling Wushu Simayan. After 20 years, Ibai Ling Chi Wan Zhou Chen Ibai Wushu Mayan. After 30 years, Sambai Wushu Suan Wu Chen Wu Bai Wushu I Mayan. Now Schwab. After 1 year, Shri Wan Lao Chen Sibai Chisha Mayan. After 10 years, Sanshir Arwan San Chen Ba Bai Lo Chi Mayan. After 20 years, Ibai Ling Suan Ba Chen Zhou Bai Mayan. After 30 years, Sambai Sanshir Zhou Wan Chi Chen Ling Sisha Ar Mayan. This time, the gap is smaller, but still clear. Fidelity finishes ahead by about $148,000. Now, here's what makes this interesting. Schwab actually starts with a higher dividend yield, around 4.03%. Fidelity starts lower, around 3.6%. So logically, you might expect Schwab to win, but it doesn't, because Fidelity has something more important: faster dividend growth. Fidelity grows its income at about 9% annually. Schwab grows at about 8.4%. And once again, that small difference compounds. This is the third big lesson. It's not just about how much you earn today. It's about how fast that income grows over time. So John gives this round to Fidelity. Score now, 3-1. Now we move to the final category, and this is where most investors are underexposed. International markets. So far, every dollar John invested has stayed inside the United States. But the global economy is much bigger than that. International index funds give exposure to Japan, Germany, United Kingdom, France, Australia, and many other developed economies. These markets often have lower valuations, higher dividend yields, different economic cycles, which can help smooth returns over time. So John runs the final test. Fidelity's fund, FSPSX, Schwab's fund, SwissX, same benchmark, same global exposure. Fidelity results after 30 years, Ibai Losha Zhouwan Chi Chen Zhou Bai Chi San Yuan. Schwab results after 30 years, Ibai Arsha Iwan Lo Chen Ling Central Lo Yuan. Difference? Over $480,000 in favor of Fidelity. This time, Fidelity wins on both fronts. Higher dividend yield, stronger dividend growth. So final score, Fidelity 4, Schwab 1. But the real story isn't the score. It's the money across all categories combined. Fidelity ends up ahead by more than $1.5 million over 30 years. And this is the final lesson. You don't need to find a perfect investment. You just need to choose the structure that gives you a slight edge and let time do the rest. Because in long-term investing, time amplifies everything. Small advantages, small differences, small decisions. And over decades, those small things become life-changing numbers.
If you want to see what happens when you start with just $1 a day in index funds and let compounding take over, check out the next video on your screen.